Okay, thank you very much, and thank you very much for the invitation. As a Swiss representative, maybe I'm really in the middle of the storm, so I will try to describe to you the situation right now. And maybe I would like to start also a little bit with some historical background, because as you know, there have been a lot of criticism, maybe against Swiss policy, but I would like to show you how much was achieved in maybe even less than 2 years, things that I would say even 3 years ago would not have been even imaginable. So this is maybe the starting point. I don't know. How do you? Can you use
Somebody
the
help
for the slides?
For the slides.
Yeah. Maybe just the first slide.
There's no slide on it.
Stefano, cerchiamo di trovare.
Yeah. Otherwise, it's, I don't need the slide.
No,
Yeah,
no,
but not perhaps the people.
For the people, yeah. Yeah.
Ah,
Yes.
okay. That's
Yeah,
good.
this one.
Oh,
Yeah, yeah.
Okay.
That's the first one. Yeah.
So we are happy. F5.
Okay.
Take F5.
Okay.
That's
And
it.
then I just do like
You
this.
can use
Ah.
this.
Okay. Yeah. I just.
Okay.
Okay.
So, that's
So the traditional Swiss position, if we start, let's say, before 2009, because everything, as you well know, happened in 2009. There's a bank secrecy in Switzerland, which is in Article 47 of the Swiss banking law, basically. And by the way, this provision has not changed. It's still enforced today. And it's also in the direct tax code, which means that the tax administration in Switzerland doesn't have the right to directly ask information to the bank. They should ask information to the taxpayer, but not directly to the bank. Of course, the bank secrecy is not applicable if there's a criminal offense. That will come back to that. So the traditional Swiss position for decades, I would say, for maybe something like 60 years, I would say, was simply to say there are double taxation treaties. Double taxation treaties, the main purpose of it is to fight against double taxation. So we are just going to use, before 2009, a double taxation treaty for that purposes, and namely, we are going to exchange information only in order to carry out the provision of a double taxation treaty. This position slowly, as we'll show you, has changed, but very slowly and dramatically changed the last 2 years. The first major change is 1984. 1984 is the enactment of this famous Swiss, what as we call is IMAC, which is a law in assistance in criminal matters, and it's a very important law because it applies everywhere in the world. So any country can use this law, even if you don't have a treaty with Switzerland. But you need, in order to get information in Swiss tax matters, you need to prove, or at least to show, some significant evidence that there is what we call in Swiss law a tax fraud or the like, in French, escroquerie fiscale. So this Swiss concept of tax fraud. Now I would like to try to explain to you what we mean in Switzerland by tax fraud, because it's a concept on which, you can find books and many articles. If I would try to make a comparison with a James Bond movie, I could say tax fraud in Switzerland, in order to avoid the tax fraud, you can only lie once. Okay? That's basically the idea. Let's say if you don't declare something, it's a lie, okay? You lie to the tax administration because you do not report. It's not beautiful, I agree, but it will not put you in jail in Switzerland. So it's a tax evasion from Swiss standpoint, but it's not a tax fraud. So what do you need more in order to fall into this category of tax fraud under Swiss position? It's what we call, and there's a lot of case law on that, is a scheme of lies. That's why I was saying you can only lie once. So if you start to enter into like using a false documentation or a very complex pattern of facts using offshore companies to deceive the tax administration, this becomes much more than just one lie. It's a scheme of lie. And then you are in trouble because it's a tax fraud. And even as of 1984, a foreign state could get information based on that pattern of fact. In 1996, more or less, what happened is that the United States, after difficult negotiation, wanted to have this concept of tax fraud or the like, not only applied in the criminal assistance matters, but also in the double taxation treaties. And this is really starting point of slowly using exchange of information in tax matters in treaties. And then, slowly following that, Germany obtained the same rule in the double taxation treaty in 2004, and then various EU states. After 1996, that's what we call in Switzerland the sort of evolution of the Swiss position. I can go very quickly on that because this is just to show you what happened, but most of you are quite aware of what happened actually. There was this famous OECD report in 2002 on bank information in tax matters. And again, in this report, the concept of tax fraud was a key element to the Swiss position. But what really, in my view, really changed drastically the Swiss position is not really what happened in 2009, but it's what happened in 2004. And not so many Swiss people do recognize that, but in my view, the shift is, in fact, the fraud agreement with the EU. Because the fraud agreement in the EU, which only applies to VAT, excise taxes, and custom duties, is the first time ever that Switzerland accepted to grant exchange of information, not only in case of tax fraud, but for the first time in the case of tax evasion. So to me, this is really the shift. The shift occurred in 2004. And how then Switzerland can continue to maintain its position in the area of tax fraud, since it has abandoned it already in the case of value-added tax. And as you know, the value-added tax is the most important tax for Minister of Finance by far. So even from a conceptual standpoint, how can Switzerland maintain this position since it has abandoned it already in the field of indirect taxation? So in my view, the shift already occurred in 2004. I can tell you that not everybody agrees with me on that in Switzerland, but it's a personal view. Then you also have, in 2004, of course, the savings agreement between Switzerland and the EU. And in this agreement, Switzerland, in the Memorandum of Understanding, has agreed to re-enter into negotiation with EU partners to grant exchange of information, but again, only in case of tax fraud within the meaning of the requested state, in this case, Switzerland. So we still, to me, it's the last frontier. It's the last frontier. We still kept this tax fraud concept for direct taxes, but not for long, because, of course, in March 13, 2009, then we really changed the policy. If you like to play with numbers, and you have to like to play with numbers when you look at the formula of the Rubik agreement, this is an interesting time for Switzerland. It's Friday the 13th, 2009. Okay? So, Friday the 13th, 2009, Switzerland accepted to adopt Article 26 of the OECD model in full. So, also exchange of information necessary to carry out the domestic law of the requesting state. But Article 26, if you divide by 2, is 13. In order to be getting out of the grey list, which was the OECD grey list, and to become a member of the club of the white countries, what do you need? You need 12 treaties or 12 TIAs. Now, Switzerland, with 12 partners, how much does it make? 13. And the last one is that at this very moment, the Swiss government decided to appoint a group of experts, which we call the task force, and I counted the number of people, and of course we were 13. So there are times in life where suddenly just a number is always on your shoulder, and for Switzerland it was March 13, 2009. So what do we do in this, what did Switzerland did this famous day? There was a press conference on that day where the Swiss Federal Council in fact made this various point. It says first we are going to adopt Article 26. Second point, which is very important, until today we didn't change a single provision of Swiss domestic law. So for Swiss domestic purposes we still have the bank secrecy. When we renegotiate our double taxation treaty, we want to make sure that there's no fishing expedition. I will come back to that. It's exchange information upon request. And then some specific and delicate areas, which is that Switzerland would require that upon the request of information, you need to identify a single taxpayer. And what do we really mean by that? There's a lot of controversy until today. This is, I think, a key aspect of our conference of today is the grandfather clause. When you play a game and you start to change the rule of the game, the rules should apply for the future. But this is the big question of today. What do you do with the past? How can we solve the problem of all this undisclosed amount which is there? And this is the key element of all this, I think. Principle of subsidiarity, which is to say a requesting state can only ask questions to Switzerland after having used all its domestic means of investigation. And negotiation of counterparts. This is very important from a Swiss standpoint, principle of reciprocity. And I think we should just put that on the table already right now. There's a lot of criticism against Switzerland, but I think some countries should at least do the same domestically as they ask Switzerland. And I think in the table some people know very well what's going on. Some countries are very strong against Switzerland, but I think this is a level playing field. So if you require a country to give all the name of the customers, when this country is requested by other states to grant the name, it should also do the same. And this is a key element of the Swiss negotiation. Okay, Article 26 of the OECD model you know very well. I just want to show you some peculiarities of the Swiss approach in this Article 26. So, March 2009, this was a decision, and following that day, the Swiss Federal Administration started to renegotiate its double taxation treaty. And look at the work that was done. I just gave you a list. In about 2 years, we have renegotiated roughly 30 double taxation treaties. Maybe we should be on the Guinness list of being the country which has negotiated the quickest double taxation treaty. And I participated personally in one of these negotiations, and I can tell you that it's a lot of stress, and we should at least recognize the work that was done by the Federal Tax Administration, which is absolutely impressive, I think, personally. Now, a few aspects of the Swiss implementation of these new double taxation treaties. There's what we call the Swiss clause in Article 26, paragraph 5. This famous paragraph 5 is, of course, the key element of the new model, which says a bank, basically, or a financial institution cannot refuse to grant information simply because it is a bank. This provision, in fact, puts an end to the bank secrecy in international exchange of information. The problem with Switzerland is that, okay, we have this provision, but on domestic Swiss law, we still have the bank secrecy. So, how can we do that? We cannot promise a state to do something and do the contrary in our Swiss domestic law. So in order to achieve that, what we did, we add a sentence to the Swiss treaties, which is to say, I mean, I'm just quoting the way I remember it, it's just to say the federal administration will have the power to implement this paragraph 5. Just this sentence. And then it means that there's an international law obligation to Switzerland to comply with Article paragraph 5, which means that the bank cannot say, you don't have the legal power to do that. Yes, I have the power because it's in the treaty. There was some controversy among scholars about the validity of this approach, but I think it's okay. Then we have implemented an ordinance which says what is basically required to identify the taxpayer. And there's this controversial aspect in the Swiss Ordinance, which is also to say that based on the good faith principle, which is in the Convention of Vienna for the interpretation of treaties, Switzerland believes that a foreign state cannot use stolen data in order to implement the exchange of information provision. This is a matter of controversy clearly. And now we come to the topic of today. So this was one aspect of the Swiss policy. We negotiate all our double taxation treaties, and we implement a provision which is similar to Article 26. But what do we do with the past? What do we do with the past? Because the problem of these new treaties that they don't apply retroactively, they just apply for the future. And we have all these assets there in some bank account, and what do we do with them? And there was a lot of discussion, and then somebody in Switzerland came from the idea of this so-called Rubik system. And Rubik, I think it's a good brand for this agreement because it's a sort of compromise. It's a Swiss compromise, let's say. Okay, it's a Swiss compromise. It's a very pragmatic approach. And I understand, and from some of the paper I've read, yes, you can discuss about equality of treatment, you can discuss about fairness, you can discuss about I think somebody even compared that to the so-called indulgences, where you can pay to be clean of your sin. Yes, you can do that. But you can say the same to all tax amnesties in the world. And this is much more than a tax amnesty, because we are going to pay the real amount of tax. It's not like the scudo fiscal where you paid 5%. I mean, we are talking about significant rate of taxes here. But I understand, I just put already things right in the middle of the discussion. It's a Swiss compromise. You know the Swiss fondue, what we do? We take two different cheese. One from Fribourg and one from Vallis. It's a 50-50 solution, the Swiss fondue. And you can say that.
But whatever cheese you use, it's got big holes in it.
I know. That's why I know. That's why I started with the cheese comparison. Okay. Now, so what is all about this Swiss compromise? We have to find a solution for the past, and we have to find a solution for the future. So for the past, what do we suggest? We suggest to have a sort of definitive tax payment at source, and which will be computed on the capital which exists at a certain period of time, which is what we call the starting period. It's basically the 31st of December 2010. And then 6 months after the entry into force of this agreement with UK and Germany, if the money is still there, the taxpayer will have just one option, but just one. Either he or she decides to remain anonymous, but then it has to pay this final tax, which is between 19 and 34% based on a very complicated formula. In most cases, frankly, it will be somewhere like 25%. So first option, you pay the tax, but you remain anonymous. Second option, you say, okay, you can disclose my name, and that's all right. But there's no third choice. So if you don't take either the one or the other, you just have to leave Switzerland. So it's what we call the white money policy in Switzerland. Switzerland doesn't want anymore to attract and to keep, let's say, undisclosed accounts. In order to guarantee this payment of the tax, the Swiss paying agent will pay upfront already a fair amount, 2 billion Swiss francs in the German case and 500 million in the United Kingdom case. And this amount will be compensated by the future, by the definitive payment. And for the future, I think this is quite an interesting approach, which is to say, for the future, we are going to apply domestically in Switzerland, basically the tax rate which are applicable in the residence country. And this is going to be quite a complicated thing to implement. In other words, the paying agent will have to distinguish between interest, between capital gains, etc., and apply the domestic rate of tax, which is applicable in Germany or in United Kingdom. Again, just one option: you accept to pay this tax in the future, or you accept that your name is going to be disclosed, but there are no third solution. And in order to make sure that all the system works, there are two new tools which are going to be implemented. The first one for the past is that Switzerland has accepted, within 2 years of the entry into force of the agreement, to disclose to the state of Germany and United Kingdom the list of the 10 top countries towards which the money before the implementation of the agreement, the money has been transferred. And when you think about it, in the current situation where you have more than 500 TIAs agreements in the world, if, let's say, Germany or United Kingdom knows that these top countries, 10 countries, have received billions of Swiss francs, there's going to be somebody, I think, even call this not the blacklist, the blackest list of countries. So this is one system which is in force into the, which is one of the tools in these agreements. And the second system, this is more for the future, is that there's going to be an exchange of information based on these treaties, under which the Germany or UK can ask if they have the name, they can ask if this person has a bank account or no, without needing to mention the name of the bank. But there's a limited numbers of these requests per year, basically between 750 and 1999 in Germany and 500 in the UK. As a compromise for that, as a sort of compensation for the whole system, Switzerland tries to get a facilitated market access, which is a very important aspect for Switzerland, because you know that Swiss bankers have been now in trouble, just doing their job, going to France or to Germany. They cannot now go to these countries to promote services because they don't have such market access. So this is basically the system, but of course we are going to go much deeper into the analysis of this, these two agreements. What I just want to say to end up this just starting point presentation is that, of course, there are a lot of pending issues with these two agreements. The first one, as we're going to discuss, is whether these Rubik agreements are compatible or not with EU law. This is a matter of discussion. I would say you can take two different positions on that. You can say it's tax agreement, and in fact, Switzerland will really levy a tax, and the tax will correspond to the tax that is applicable in the resident state. If we take this position, I'm not an EU law expert, but basically, if it's a tax law problem, it's not in the competence of the EU Commission. But if you take the position that these agreements are just here to fight against tax evasion and fall into the scope of the Savings Directive, of course, the position could be quite different. I think this is the issue which we can discuss. A second pending issue, as you've seen in the press, is that Switzerland is right now under a lot of pressure. But when I'm telling a lot of pressure, I think it's unprecedented, the pressure which is against some Swiss bank right now from the United States. What happened is the following, or what we call the UBS case. And you know, the UBS case is just based on the double taxation treaty of 1996. So we don't even apply a new treaty with the UBS case. And the question was whether the client of UBS, which did not report, were committing a tax fraud or the like based on Article 26 of the US Treaty. And following that, Switzerland made a very special agreement with the US with a very broad and, I mean, quite controversial, to say the least, definition of tax fraud or the like, but within the context of the UBS case. Everything was settled, and 4,250 names of UBS clients were sent to the United States. And Switzerland thought, everything is fine, we have solved the case, and we can go back to work. The problem is that in the meantime, the United States entered into a voluntary disclosure program in which many US customers could just go and just mention that disclose their wealth. But, yeah, and when they do that, they have to fill a form. And when you fill a form, you have to fill the name of the bank, the name of the asset manager, maybe the name of the fiduciary company that created the trust, etc. And we are talking about 16,000 more or less voluntary disclosure forms. And based on that, the IRS got a huge data of information, and they discovered that apparently there were other Swiss banks that unfortunately, and I think quite problematically, were taking a US client with undisclosed assets. So based on that, there's a new pending cases against 11 Swiss banks. And as you may know, there's even one of the banks which just disappeared because they indicted the partners of the bank. It's the bank Voegelin, which just now disappeared. The oldest bank in Switzerland from the 18th century in 1 month has disappeared. So it's a serious matter. And the last aspect will be the evolution of the EU legislation, in particular the Savings Directive, which could also have an impact on that. So this is the starting presentation about the Swiss aspect. I want to summarize and show how much was achieved in roughly 2 or 3 years, and take this solution again as a Swiss compromise. Thank you very much for your attention. Yeah.